acquired or sold large. Since East Cambridge Savings Bank is a mutual bank and does not have shareholders, we reinvest profits locally through mortgages, loans for small businesses, and supporting nonprofit organizations. At this time, I turn it back to you, Teresa. Thank you.
Thank you, Robert. Okay, I want to just tell you a wee bit about SCORE as we get going. SCORE offers a couple different opportunities for our clients. One of them is training, which you are here for today, and I strongly encourage you to check out the websites for upcoming webinars or to watch for our newsletter that comes out. It'll come out from each of your chapters, but it does tell you all the events that are going on in our entire district. The most important thing that SCORE does, though, is the mentoring. Mentoring is always free and confidential, and our mentors are volunteers, and they have a wide variety of knowledge and experience that they want to share with clients. We work with clients that are just thinking about starting a business, are in the process of doing that business plan and getting started, and businesses that are already established that have questions. Growth questions, marketing questions, you name it. We're there to help with that too. Often I'm asked, what is a session like? A lot of mentoring sessions are on Zoom or by phone, some email, and I think some chapters are ramping up their face-to-face. I know in Boston, we have a couple, not very many, but a few face-to-face sessions. And sessions last anywhere from 30 minutes to 60 minutes. And it really depends on the questions you have for that first meeting. But in that first meeting, you're going to work with a mentor and establish a relationship, and they will help you come up with a plan and goals for the next steps. And you can continue to work with that mentor, or that mentor may invite other mentors to work with you in future sessions. Okay, so how do you get a mentor? That is very, very easy. You can put a note in chat and I'll make sure the right chapter reaches out to you, or you can go to the websites listed here, and I will put those in chat after I finish the intro so that you can access that information. If you had a mentor a long time ago and it's been a while, reach out. Definitely love to hear how things are going. Okay, we do anticipate quite a few people on the webinar today. So I strongly encourage, if you have a question that you would like asked to the presenters, please put that question in Q&A. You can use chat for everything else, but it allows me to keep track of the questions that have been answered already. So please put questions that you want asked to the presenter in Q&A. All right, so I'm going to go ahead and stop my share, and I'm going to go ahead and turn it over to our SCORE mentors.
Teresa, oh, there it is. Okay. Welcome, everyone. My name is Gloria Spence, and I am a SCORE counselor and a webinar presenter. I have been with SCORE for about 5 years now, and my background is finance. I have a corporate background. Usually, I work with clients related to cash flow, financial statements, those types of that specific area of their business. And so today, Jim, do you want to introduce yourself right now, or do you want to do it later?
I'll do it later. That's fine.
Okay. So today what we're going to cover is we're going to just take a very quick brief overview of all of the financial statements. Also talk a little bit about startup costs and budgeting, but primarily this webinar is really to talk about cash flow statements. It is probably one of the most important reports for a small business. And then we're also going to talk a little bit about how to manage your cash flow and to how to forecast it in a little bit more detail. So the objective of financial reporting system is to gather accurate and complete information in a timely fashion. And this is all designed and helps you to make better, smarter decisions about your business. The key is accuracy and completeness. So what are the basic financial statements? Whether you're a small business or a large business, these statements, these reports are all the same. Income statement, also known as a profit and loss statement. And this report shows results of a business for a defined period of time. They usually go on a monthly basis and a calendar basis. The balance sheet is a snapshot of your financial position as of a specific date. It talks about what the business owns and what it owes. And then, of course, the cash flow statement. And this report shows where the business's cash has come from, where it has gone, and it's over a defined period of time as well. And again, usually it is a 12-month period. When you're starting out, it's a good idea to have more than 12 months, but you want to do at least 12 months. So when you're starting up, I do want to ask a question. If you could put in to the chat, how many are in the startup mode that has never done a cash flow report, or if you could put in there, how many people are in business and just have never done a cash flow? If you could kind of just tell us a very brief, that would be helpful for us as we talk more about this in detail. But all startups need to prepare a cash flow budget. And we'll look at what one of those looks like. And when you're starting up, you want to do your startup costs, and then you also want to project out on a monthly basis for at least the 12 months that we talked about. And you want to include your costs expected for, again, the 6 to 18 month. And the reason for this report is that you want to know, are you going to have enough cash, or how much cash do you even need to get going? And you always want to include in this budget as a contingency plan, because for everything you remember, there's always going to be something that you forgot to include or you over or underestimated. Now, we do have other webinars that focus exclusively on startups, but I did want to tell you that this is very important to when you're starting your business out. And you really should always do a budget at the beginning of every calendar year. So what does the cash flow do? What's its purpose? It shows the movement of cash in and out of your business. And you want to develop a discipline of looking at this cash flow at least on a monthly basis. Now, if your numbers are very tight, you don't have a lot of cushion in your cash flow, then you want to look at this a lot more often than monthly. Once you get established, you'll have a better sense of it all, and you won't need to look at it quite as much. But in the beginning, you should be always updating and looking at this report on a regular basis. So we're going to talk about how you prepare a cash flow statement. And in that, it's going to tell you, you're going to answer the question, how much cash do I need? And that number includes your expenses. That's actually the easiest part of putting this report together. What are your expenses? And what you want to, if you're already established in a business and have never done a cash flow report, where you want to start with this is on your bank statement. You want to take a look at your bank statement and analyze what is going through there and put it on this Excel sheet that we're going to talk about a little bit later. The other important question that you want to answer is how much cash do you want to take from the business? What do you need to keep up your personal lifestyle? So then you want to get those two numbers, and then you want to say, what's reality? And that's where the hard part comes in, which is figuring out where and how much your revenue is going to be. The expense part of this process is relatively easy. The projecting of your revenue is the difficult part. And we're also going to talk about, too, how to use this report to manage your business in good times and in bad times. Here is a very brief overall look of what this report looks like. And we're going to get into a little bit more detail. And I am going to pull up up an Excel spreadsheet. All right, we can see this Excel sheet now?
Yes, we can.
Okay, good. Okay, so this report is a very summarized version of what you want, what this report is supposed to look like. And the key lines here are, you're going to start out with what your beginning balance is in your checking account. And it's very important to plot all of this information out by month, because you want to know when you're going to run out of cash and how much cash you have. So as I mentioned before, the difficult part is the income, but we're going to jump down here to the expenses. This number here is going to tell you how much money it's going to take to operate your business. If you take that number, $158,000 for the total year is your expenses. And if you want to take from the business $60,000 or $5,000 a month, you're going to need $218,000. Now, you can see up here that you've already forecasted that you're going to do 275. So you're in good shape, assuming that everything that you predict is going to happen happens. And the reason why this report is important is that it will tell you when you're getting off your plan, whether it's for the good or for the bad. So so remember that the numbers that you're looking at here that you have to arrive at is total income, total expenses. And I've got a couple other things in here, but I don't want you to worry about them or talk about them right now because they'll just confuse everything. So income, expenses, and how much you want to take away from the business. And then at the end of all of that, this line down here will tell you how much money you're going to have in your checking account at the end of each month. So as I mentioned, that was a summary. I just want to show you how detailed this report can get. It can get overwhelming. But remember, these are your numbers. These are your descriptions. You can go in there and change these to whatever you have expenses running through your business. But this is the granular detail that you want to get into eventually. So you'll notice here that I've got I'm going to jump over here to March. So you notice here that I've got these 3 months shaded. So what happens with this report is that each month after you have completed a calendar month, you want to go in there and you want to update this and you want to put your actual numbers in. So at the end of each month, you can shade these or not shade these, but we emphasize this here so that you can see that these are actual numbers, January through March, and these are forecasted numbers. This is what you think is going to still happen. Now, what this report is telling you here is, I'm going to jump here to line 24. And you're going to see here, we've got employee expenses. And you're also going to see here that these numbers jump, they increase. And the reason why we have this in here is that about this time each year, you're going to start planning for next year. And you're going to, this company is going to add employees. So that's what this line is. And this report is telling you what happens to your expenses, to your cash flow when you add employees. So when the assumption on this particular report is that when you add employees, you're doing it because you're increasing your revenue. So in order to increase your revenue, you're going to have to add employees, or you're going to have to do something to do that, to increase your revenue. So if you take a look here, you can see, jumps and for example, here, you've got insurance, you're budgeting that for $4,100 in the month of October, because that's when it's due. And so preparing this on a monthly basis is really very important. So let's jump down here to this line, and at the end of March, and I didn't update this report from 2020 because the pandemic really showed how important this report was to businesses when we got caught in the pandemic. If you'll notice, if I go back here to this budget, you'll notice here that I had 24, 29, 36. My revenue was ramping up in the summer months. But, you know, what happened in March was the revenue started to fall apart because of the COVID thing. So we went in and we adjusted these revenue figures, assuming that this was only going to last a month or two. As we well know, it lasted longer than a month or two. And eventually, if I look here to May, eventually these numbers all went down. And so my revenue that was originally at $275,000 now happened to be at $110,000. So that big of a difference in your revenue is going to tell you, hey, I got to do something with my expenses. And you can see what happens here when you continue to keep your expenses at the same amount, you're going to come into a deficit. You're going to run out of cash. Because remember, your cushion when you started the year out was $51,000. So a number of things have to happen. This report is telling you, I gotta, you know, in this particular case, I'm not going to hire these new people because I don't have the revenue. I don't have the revenue to support them, and it's not even out there. And you may have to go without salary. You may have to go without taking your pay. And actually, you're going to have to do that. You may have to do that again. So what this report does is interactive. I can just go in here and do that. And if I know in advance, which I do because I'm preparing this in advance, I'm going to hit it there and I'm going to say, okay, I'm not going to pay my salary now for these 3 months, and it'll get me through September. And then maybe I can pay myself again if business picks up or not. So again, this report gives you the opportunity to go in and play what if games when you need to. The other thing is this report is not just for when things go bad. If your revenue, for whatever reason, takes off, now you can have all this excess cash. So then it gives you the opportunity to decide, am I ready to expand, or do I want to just put more money in my pocket? So this is a reason why this report is so helpful. It does give you opportunities to play what if games. Now this last tab here is very basic, okay? It is formula driven that will say, if the easiest example is services. If I have a service and I provide 3 different types of services at these amount, what do I need to get to the numbers, to my revenue numbers? And I can play around with these numbers and say, well, I'm going to have 16 hours at $200 an hour, and that's going to give me down here $3,200. I go in here and change this number to 10, and my number now goes down to 2,000. So these numbers here give you opportunities to play what if games. So that's basically this report. And any questions?
Yeah, before you leave the report, can you
Yes.
please tell everyone what the 4-digit accounting numbers are on your first tab?
Okay. In a perfect world, when you set up your accounts, you're going to assign them account numbers. And the accounting bookkeeping world has typical numbers that these are assigned to. It can be overwhelming when you're setting these up. If you're just using an Excel, you don't need them. But if you're going to progress to a QuickBooks or to some other accounting software, eventually you should have these numbers. They help to categorize things and make your financial reports cleaner. But they are not necessary for this report.
Thank you. That's all the questions I have at this time.
Okay. All right. And the chat, what's the ratio of brand new businesses and no cash flows? Does anybody Did we take a look at that? In
Oh, yeah.
AES?
So we had most people have been in business for are just getting started or for about a year, but they have not done a
Okay.
cash flow. That's mostly what we saw. There was one person that has been in business for a little bit
Okay.
longer and looks like
Alright.
a cash flow statement would help them a lot. Yeah.
Okay, perfect. Okay, Jim, I think you are up next.
Yep. So you stop sharing your screen. Good.
There you go.
Okay, I'm Jim Danhauser. As Teresa mentioned earlier, I'm a volunteer with the Cape Cod and Islands chapter of SCORE. My background is in finance. I spent a significant part of my career as an investment banker and then was a CFO of a company. And I have been working with SCORE since 2013, both in our educational programming as well as by providing mentoring assistance. So one of the things that I constantly deal with clients is making sure that owners recognize that they can offload a number of things from their plate. But one thing that they should make absolutely sure that they keep on their plate is monitoring their cash position. You'll often hear the expression that cash is king, and you're probably sick of hearing it, but there's a reason that that's a common expression. It's because it's true. In fact, if you look at it, most small business failures can be traced to liquidity problems. Running out of cash is death for a small business because you don't have nearly as many options to look outside of the business for financial assistance as larger enterprises do. So it's critical that you stay on top of your cash resources and your current and future cash needs to avoid that liquidity crunch and to anticipate it as early as you can if you're going to have problems. Because inevitably what happens is that your problems cascade geometrically and your options for dealing with them are much better the earlier that you recognize that you need to do something. So there are some simple practices that can help you a lot in trying to keep track of the cash position in your business. I strongly recommend that you have a separate bank account for your business. Run only the receipts and expenses of the business through that account and none of your personal expenses. Why? It is really the easiest way for you to monitor the cash flow of the business on a monthly basis. You can look at the bank statement. It also actually facilitates eventual tax return preparation. And your accountant, if you use one, will be very happy that you have a separate bank account. I had a client once who just didn't do this. And they came to me after 3 years and they had to sit down and go through a laborious exercise of stripping out all kinds of personal expenses to see how actually the business was doing. You just can't put yourself in that position and manage your business effectively. I would also tell you that it's, if possible, you should have a separate credit card for the business as well. Why? Again, it enables you to keep separate your business expenses from your personal expenses. People sometimes ask, well, doesn't a debit card do the trick? And it can, but the benefit of a credit card is that it is not just dependent upon you having cash in your bank account to cover the cost. I would never advocate using a credit card for significant amounts of business credit because it is an extraordinarily expensive form of financing if you don't pay it back on a monthly basis. But in a pinch, if you need something for inventory or supplies and you don't otherwise have the cash available, having that separate credit card can really help get you over the hurdle. In addition, as Gloria said, you really need to look at your cash flow position at least monthly. You can use that Excel spreadsheet, and I know that Teresa has posted the template in the chat. I would encourage you to download it and familiarize yourself with it. It looks somewhat daunting, but Excel is a very easy, user-friendly system, and once you use it a couple of times, you'll be fine. If you don't want to use that, frankly, take your bank account, take a piece of paper and a pencil, and just make sure that you are tracking where you stand on a monthly basis. And you really do need to have a cash flow forecast for the next 12 months and keep it updated. Circumstances change, and you need to take account of those to be sure you stay on top of your liquidity needs. It doesn't have to be terribly detailed. It doesn't have to be overly complicated. But sitting down and making sure each month that you know over the next 12 months what you can reasonably expect to come into the business and what you know is going to have to go out will help you to avoid those problems that I was describing earlier, and also may help you to make better decisions about your business. You should maintain good accounts receivable collection practices, and we'll talk a lot about that. And I would encourage you to avoid overdoing it on supplies, inventories, and equipment. I know, people in business want to make sure they have everything they need to have by way of inventories. If you run a retail operation, you want to make sure you have full shelves, but be careful because that eats up cash. And that cash then ends up sitting in products, supplies, and inventories. And you may find that you actually wish that you still had it. Cash flow forecast. That should be part of your annual budgeting process for the business. And as I said, you should update it every month. And if you find yourself in a position where you are getting very close, then you should be looking at it more frequently than that. And look particularly at what's coming due over the next week and the next month to see if there are issues that you need to attend to. Because there are things that you can do to get you over the hump of problems. And remember seasonality. I know that for those businesses on Cape Cod, you're acutely aware of it. And I tell people all the time, it feels great in June, July, and August. But in my experience, every year, February and March still come around. So make sure that you recognize that you will get slower months and that you take account of that into thinking about your cash flow. Now, what do you do if you see a cash flow shortfall on the horizon? Well, there are steps that you can take to deal with it, and the sooner you deal with it, the better. You could seek working capital or other financing. Look at your expenses, as Gloria was indicating, and reduce or delay expenses that you can avoid incurring for the time being. You might delay purchase decisions. Sorry, I got a notice from Microsoft wanting me to do something, so I had to close it. You could try to accelerate the collections of receivables. And I have had clients ask me, well, if I see a problem, should I meet with creditors? Should I tell them there are going to be issues? That's a ticklish question because you don't want information getting out into the marketplace that you are having cash difficulties. You may have problems then with suppliers. But if you know you are going to have issues, then meet with people and tell them honestly and explain how you're going to deal with the situation. Generally, people are much happier to not get surprised. And you should try to keep cash reserves, or as I said, establish a working capital line of credit in order to make sure that you have the ability to deal with shortfalls. Now, I see some things have come in on the chat. Teresa or Gloria, do we want to try to deal with those now?
We're just been having a conversation about how they're realizing how important cash flow is and getting started with the next steps. And I've been encouraging a SCORE mentor to help them get to that next step.
Okay. I wanted to come back just for a minute to this very simple cash flow forecast. And there's a couple of lessons that I want to just have you draw away from this. This is a business, it's artificial. I just made it up for purposes of discussion. Started out the year with $20,000 in cash, brought in $335,000 in cash, spent $349,000, so it was $14,000 negative cash for the 6 months. That's okay, it started out with $20,000, so it's still in a positive cash position. Well, look how close to the edge they get in February. They're down to $1,000 in the bank. Why? Well, they ramped up an inventory purchase, presumably in anticipation of getting ready for their season coming. If they had a cash flow forecast in hand and recognized how tight things were going to get, they might have delayed that inventory purchase. They might have sought to buy some of it on credit, slow it down, take some steps to avoid getting as close to the edge as they get, and then look at March where they find themselves negative. Why? Well, you'll see that they spent $12,000 to buy a piece of equipment. Now, obviously, that number is tiny. You'll be laughing to think that somebody could get into trouble for that. Put another zero on it, and you'll realize how significant it would be. If you knew going in that you were going to be putting yourself into a negative position, you might delay that equipment purchase, or you might try to buy that equipment or lease it from the supplier instead of buying it outright or buy it on credit. Because you will find that equipment vendors are oftentimes the most likely source of financing because they're accustomed to dealing with providing lease financing and other options to people. So again, it's a simple example, but the point is, if you didn't have a cash flow forecast, you didn't realize the issues you might get yourself in, and you can't make smart decisions about your business, whether that's trying to preserve yourself from getting into a cash problem, or is it thinking about expansion, because that always comes with expenses. You just need to have a cash flow forecast in hand that is realistic, that covers a 12-month period, so that you can actually just make smart decisions about what is probably your most important asset.
Hey, Jim, can you tell what the slide that you were just on, what cash receipts mean on that sheet?
Sure. That just means the cash that the business got in, whether that's by something that was provided by service or products sold in cash, or collection of accounts receivable from prior periods. It very simply says, okay, how much cash in January did I get in the door from whatever source? Not including financing. Is that helpful?
Yeah, and if it's not, please go ahead and submit a follow-up question.
So I'll come back and talk about accounts receivable. If you're in a business that doesn't generate accounts receivable, good for you. You should be very happy that that's the case. But this is a major issue for small businesses and causes as many liquidity problems as almost anything else. And it can end up being a major time suck for the owner of the business. So it's important that from the get-go, you develop and maintain good practices. What are those? Well, first, I can't tell you how many times I've dealt with clients who sort of get the bills out when they can. Well, whether you do it, you have an accounting system that does it for you, or you have a bookkeeper or someone else, you're really going to help yourself significantly if you get bills out as soon as the work is done. The bill should clearly state what's been done, what is owed, and when payment is due. If you have an accounting system, whether it's QuickBooks, FreshBooks, Wave, or others, most of them will have an invoicing tool, which will allow you to just have the system issue the invoice. The benefit of that is it tracks payments for you efficiently. It'll integrate with your accounting system, and you can then just, in the odd 5 minutes of time that you find somehow miraculously to deal with it, you can go in and look at the accounts receivable and see whether people are being slow in paying to you. We would advise that you send invoices out, not just by email, but also by regular mail. Make clear how the check should be made out and where they should be sent. And if you take payments online or by credit or debit card, make it clear how that is to be done, because that can help you significantly. More and more people don't like necessarily to be writing checks and sending them out. You also ought to have somebody in your organization or yourself get to know who at your customer is actually making the payment. And communicate with them regularly so that you know that they receive the bill and that they make sure that they are making the payment to you when you need it. You do have to monitor the collection process. Get reminders out when payments are late. You don't need to be nasty. And no one wants to be nasty in business. That's not why you got into business in the first place. But reach out to customers just to find out if there's a problem and encourage them to pay you. Because it is your cash and you've done whatever you were supposed to do and you are entitled to the payment. I've had clients ask me, should I get involved with lawsuits to try to collect outstanding accounts receivable? Small claims court can be done. I've had clients who've just refused to be stiffed by anybody and they go to small claims court because they think it's important. But recognize there's expense involved in that, and there's your time involved in that. And oftentimes you can have a Pyrrhic victory because you'll get a judgment, but the person won't be able to pay you anyway. So check on their ability to pay before you do that, and be prepared to negotiate to collect what you can before worrying about it. What else can you do? Well, you could consider early payment and prepayment discounts for customers. Now, why would you do that? Well, it gets you out of the headache of collecting, number one. Number two, it may get you cash in a slower part of your season. For example, I have someone who takes care of an in-ground irrigation system that I have. They give me an option in March to pay for the full year's general service and get a 5% discount. I don't mind doing that because it enables me to not have to worry about getting that bill and paying it every month. They don't mind doing it because even though they're giving me a 5% discount, they're getting cash in what would otherwise be a very slow period of time for them. And again, it gets them out of the headache of worrying about receivables, and it gives them certainty about the cash position that they have. You could also consider getting credit card authorization for regular customers and charge them after the invoice is approved, but be careful because you need to safeguard that information if you get it. You could also accept payment by PayPal or other means that don't require you to get that authorization. And most times you can set that up with your bank. And those are all very useful ways to get out of the collection business because you don't want to be in that. If you're in the construction business, if you have bigger projects, make sure you get a payment schedule that works for you and get as much upfront as you can. And you should not be making huge supply purchases out of your own pocket. What else can you do to help with working capital? And some people don't know what I mean when I say working capital. That is simply the excess of your cash and other current inventories over the bills you have to pay near term. As I said before, you should avoid buying supplies, equipment, etc. And if you find yourself with large amounts of unsold inventory, it's not going to get any more attractive the longer it sits on your shelves. So consider trying to reduce the price to get it moved and get at least whatever cash you can for it. Whenever you're making purchasing decisions, do it with the impact on your cash flow forecast in mind, and pay your accounts payable on time, but you don't need to pay early. I know everybody wants to be a good customer, maintain very good relations with their important suppliers, and that's something you really do want to do, particularly for a small business. But if somebody's giving you 60 days terms, don't pay it on the third day. Just pay it when it's due and put it in your cash flow forecast as going out at that time. And don't use tax or sales or meals tax withholdings as your cash. Most of you will have employees and you'll have employee withholding obligations. You may be in a position where you collect sales taxes. Make sure that you turn that money over to the proper authorities as and when it's due. I've had clients who said, well, I have a minor problem here. It's just going to be temporary. I'll use some of that money to pay those bills and I'll make it up later. That's a big mistake because it can be a significant liability for you. You could end up with criminal exposure. It is not your money. It's a big mistake to take the risk of using those funds for your business. The other obvious thing that you want to do to help with your cash resources is to look at financing. Now, this is just a chart list that shows you the various ways that small businesses can get started with money from others or seek money as they're going. Family and friends is a euphemism. It means anybody in your network. You may want to use your personal savings or assets to help to fund the business. That's a question of personal risk preference. I've seen clients who decided to use some of their retirement money to help to fund the business. Just make sure that you are prepared to recognize that you could lose that money, and then you would be in a position where you'd have to replenish that from other sources. The SBA is a good source of financing for small businesses. They work through local banks, and you can certainly go on to the SBA website and use a lender match feature that they have to see whether there's any banks who would be prepared to work with you in terms of getting SBA support. Bank loans can be difficult, but you are much better served to start dealing with local banks than you are to simply wait. You often will be better off not dealing with the money center banks, but dealing with the smaller community banks in your area, because they can be much more familiar with the financing requirements for small businesses and more comfortable dealing with small businesses than the larger banks might be. And it's important to start a relationship with a bank. It's much harder to walk in cold and ask for a loan. But if you start with a bank, when you open up your business accounts, meet with the manager of the local branch, explain what your business is. You'll have your checking business with them. And the more they get to see you as a responsible business person, maintaining a good bank relationship, the better chance you'll have down the road, if you need it, of getting potential bank financing assistance. You can also, as I mentioned earlier, you oftentimes find ways to get equipment financing against particular pieces of equipment and supplies. Online lenders exist, and these include lending sources that will provide online working capital financing. They can be very convenient to work with. They can also be deceivingly expensive because they charge fees, and then there's an interest component on top of that. And if it's a short-term borrowing, it can be expensive, but they're there. And these are folks like Cabbage and others, and they work very closely with small businesses. So if you're thinking about seeking outside financing, I would tell you that the places to start are your local community banks, the SBA, and potentially thinking about online lenders. Crowdfunding, is all hot and new several years ago. People have generally recognized that works well for big stories. Somebody has a very exciting new enterprise. It's a cure for some disease. Somebody has illness and needs support for health. Do not underestimate how much time and effort is involved in trying to do a crowdfunding. And you'll have much better luck dealing with the more traditional sources of financing in most circumstances. So what are lenders going to look at in thinking about making a loan to you? Well, first thing is collateral. What assets can secure repayment? They may want a mortgage on your business or personal assets, and you can almost always anticipate that they will want you to sign personally for any loan that is being made to the business. That means if the business fails and the loan is not paid back, they could potentially at least come after you personally to get repaid. That's not really the main purpose for which the banks or other financing sources will want a personal guarantee. They're really testing to make sure that you are confident enough in your business and your business prospects to take on that level of risk. But don't be surprised. And it can be something that you'll sit back and think hard about, and you'll talk to your life partner, your business partner, and others. I know the first time I had to sign one for a small business I was starting, I thought a while about it, but then I realized that if I wanted to get the business going, that was something I was going to have to do. The financial entity is going to absolutely look at your character, your experience, and your business plan. And how much can you demonstrate that you actually understand what you're getting into? Why you? You'll have to show the financial institution that you have the relevant experience, that you have researched the opportunity, and that you have a real sense of what you're going to do and how you're going to make it successful. And then they'll look at capacity conditions and other things. It's traditionally called the 5 C's. So as I said, you want to establish a banking relationship, even if you're not getting a loan. Try to establish merchant credit for your supplies. Consider working capital financing, including those newer online sources, and work on establishing a good track record for your future needs, and maintain your personal credit rating as well as you can, because that is also something that financial institutions are going to look at. Now, I spent a lot of time talking about the problems and how you deal with the problems. You want to have a cash flow forecast and manage your cash flow for the opportunities as well, because opportunities will come along to you. And when you assess those opportunities in the context of your business, inevitably growth is going to require cash. You're going to have to either hire new employees, arrange for new supplies and new inventories. There may be great opportunities, but they won't necessarily generate revenues right away. So for that, you need to do your cash flow forecast. But if you don't have that forecast in hand, you may be afraid to take advantage of those opportunities, and that will prevent you from achieving the growth that you might otherwise be able to achieve. So you want a cash flow forecast in hand, not just for the bad times, but also for the good times. And you never want to be in a position where you don't understand where the cash resources of your business are. And with that, we'll turn it over to any questions or others that might be in hand.
Yeah, we have a couple questions in the Q&A, and then I think Debbie Dobbins from the bank is going to talk about the bank's perspective on cash flow. So we have a question. What is a reasonable amount to pay yourself in salary? And in terms of monthly expenses, should the entrepreneur factor in their basic living expenses? What is the minimum cash reserve credit line should be?
Gloria, I don't know if I'll start with that one. Don't put any of your personal expenses in the business cash flow forecast. That's not the business expense, that's your expense. So that makes it a little bit simpler. But you do have those living expenses. And you need to make sure that you have the ability to cover those by what you can take out of the business from the business's cash flow. In terms of what the level of financing is, well, if you're starting out, people will tell you that you want to have sufficient cash resources to cover 12 to 18 months of expenses. And if you're in an established business that you have a pretty good track record for being cash flow positive, if you have cash reserves in the business covering 6 to 9 months of expenses, you should be in pretty good shape. A working capital line of credit is a very useful thing, because it basically means that a bank or lender is ready to provide funding to you as it's needed. Again, if you have an element like that covered 9 to 12 months of expenses, you'd be very comfortable. The way that working capital lines of credit work are you pay a commitment fee to the lender for the amount that they are committing to lend to you as needed. So let's say, just for hypotheticals, that you get a $50,000 working capital line of credit, which entitles you to draw on it as needed. You'll probably pay a commitment fee of anywhere from 1 to 2% of that outstanding amount. You'll pay interest on that loan as the loan is outstanding. And ordinarily, you will be required to pay that working capital line balance down to zero at least once a year and leave it at zero for at least 30 to 60 days. So I know, Gloria, if you had anything further you wanted to add.
Well, the only thing I was going to add is to your first question, what's a reasonable amount? I mean, there is no reasonable amount. It really boils down to what do you need to live? If you don't have excess cash in your personal funds, you know, it's not unusual to go for a number of months in the beginning of your business without getting paid. So you're going to want to make sure that you have extra cash in your personal life, in your personal account, to cover your own personal expenses as well. I mean, again, you may not have enough money to pay yourself in some months.
And you just have to be sure, as you sit and look at it, you talk to your life's partner, you talk to your business partners, you have them, and recognize that that's going to be a potential reality. And then you have to assess whether that's something that you are prepared to do. And if you just can't, you can't. Don't fool yourself. You know, if you don't have the cash resources, then, you know, people hate to hear this, but maybe what you need to do is continue whatever employment that you currently have, and keep working on starting the business in addition to that, so that you continue to have some source of income during those months where you need it.
Okay.
I see somebody asked, how do you account for cash received by family and friends who help fund the business? Well, that depends. Do you take that money in as a loan, or do you take that money in as an equity investment? If you take it in as a loan, then it is considered as a loan on your balance sheet, and you have to pay it back in whatever terms that you agree to them. Tax-wise, what that means is you would get a deduction for the interest expense, but you would not get any deduction for the repayment of the principal. If you take it in as equity, well, then they are part owners of the business for whatever terms you've agreed to them with. They will get whatever tax attributes of ownership that you would get as an owner as well.
Okay. We do have another question. Do you recommend billing.com or Stripe for your billing?
Well, we're not really supposed to recommend any one particular tool. There are a number of billing tools that are available that can. You want to make sure that whatever tool you use for invoicing can sync with your accounting system itself. And then you just shop for it, see what's the least expensive that you can get. If you're thinking about taking credit at whatever location you do business out of, then you need to get a credit card processing arrangement put in place, which needs to be coordinated with your bank. But you can shop for those as well. They are getting much less expensive than they used to be. And the other way I know that some of my service clients have managed to eliminate the accounts receivable problem is they carry Square with them. And when they finish a job, you give them your credit card and they collect payment on the spot.
Okay. All good
Now,
advice.
those credit card charges, payments come with the fees that we had mentioned before, but you budget for them and it's a cost of doing business. So you include it in your expense portion when you're trying to calculate how much you're going to charge somebody. But in my opinion, it's the better way to go. This way you don't have to worry about collecting.
And talk to, whenever I talk to small businesses and I start talking about accounts receivable collection, you can hear the moans in the room because of the amount of time that people are spending on that instead of running their business, which is what they got into business for. So the more ways that you can effectively deal with that, the better. I know that some people have tried the prepayment arrangements, and maybe the discount was too big, and too many people took advantage of it. I wouldn't advocate doing 50% off. But if you do 5 to 10% off and you get a full year's payment in advance, that's not so bad. Especially pretty soon, you may actually be able to earn some money on whatever's sitting in the bank.
We have another question, and I think it's a great question. What does it look like to pay yourself from the bank account to your personal account? Is a transfer enough of a paper trail?
Well, first, it depends on the type of entity you are, because if you are a sole proprietor, an LLC individual, then you would just pay yourself. And again, it comes back to an accounting issue where you would show it. You would show it on your balance sheet. But if you are incorporated, for example, then it's coming out of payroll. Jim, you can add more to that if you would like.
No, I think that encapsulated it accurately. You don't have to cut a check. You can do a bank-to-bank transfer or account or transfer from the business account to your personal account. You just need to journal, show in your records that that's what that was for.
Okay. I actually have a question that is for the bank. If Debbie and Robert could come back on screen, I can ask this question.
Sorry about that.
Okay, Debbie. Yeah, this person established a business line of credit with a bank, which is personally guaranteed for a business that's been in the black for now 5 years. Is there a point in time or a method when this can be changed to be not personally guaranteed?
Well, it really depends on the size of the business. It's actually, I'm surprised at how large a company has to get before a bank will not take a guarantee. And if there's real estate involved, it might be a different discussion. But companies that are usually, I don't know, upwards of 20 to what do you see, Jim? Upwards of 25 to 50 million, they're still taking guarantees.
Yeah, that's it. And in part, once a bank gets a guarantee, it hates to give it up.
Yeah, it's true.
Because the banker who's making that decision with this approval of the credit committee is going to be the one who's on the line if there's ever a problem with the loan.
Yeah, it doesn't hurt to ask, but I wouldn't, if you have a good relationship with the bank, I wouldn't damage it too much by pressing on that point.
Yeah,
But
because
I-
they also might begin to worry. It's the old fear that you may know something that they don't know. It's like, when the Fed decides to cut interest rates, everybody's worried that they see a disaster coming. So you just have to be careful with that conversation. If your business is really doing well, then, the personal guarantee becomes less a personal exposure. It's nonetheless a risk.
Yeah, I agree with that. I did have a couple of things I want to say, but happy to take any more questions. First of all, I want to thank Jim very much for the shout out on local community banks, because that's what we are at East Cambridge Savings Bank. And it does really make a difference. I've worked at large money center banks, and I've worked at a few community banks. And my experience with the local bank, if you keep up what Jim recommended, an open dialogue with the bank when you're having problems, the bank will want to work with you. So I would take some of that advice that he gave you guys to heart on those points. The other thing I wanted to add is you guys both did a great job representing the financing and things that we would say. I did want to add something to what Gloria was saying about what happens when you find yourself flush with cash and you need to decide on how to spend it. And investing in the business can include many different things, right? From adding employees to buying equipment. Some of those things would be financeable potentially by a bank and some would not. So you're kind of at a decision point. If you're at that point where you're trying to decide about investing in the business and seeking the advice of people that might be more experienced than you, or even talking to your bank might be, those might be worthwhile conversations to have at that point. And yes, I agree with what I think both of you said, that you do want to establish a working relationship with the bank as soon in your the life of your business, even if you're not at the point of needing bank debt. But start asking to speak to a lender when you start seeing that you can benefit from having a some type of commercial loan. And then the other thing I would just say, having seen people who don't do what Jim recommended, is paying attention to the financials and your cash position. Gloria also did early on, just having the habit of it, not being afraid of the numbers, but some people are by nature not afraid, but some people are. And if you know that that's one of your fears, you know, try to work psychologically to get over that, because cash is king and the numbers will end up driving the business more than you can drive it if you're not being successful financially. Happy to take any other questions.
I don't see any well, I had somebody with their hand raised. Did you want to speak out? Did you want me, I can allow you to talk if you want to ask a question out loud. Let me go ahead and click that. And Linda, you can go ahead and unmute yourself and go ahead and ask your question.
Maybe that was an accidental hand raise.
Maybe that was an accident. Sometimes that happens. No problem.
It's not the first time, and it won't be the last.
Yeah, no problem, Linda. We'll put you back.
And then I just like to put in a plug for East Cambridge Savings Bank and for Robert and me and any other, location we might have that would suit you. If you feel like you want to come in and talk to a lender or start to learn about the banking side a little bit, please feel free.
Okay.
Yeah, if you don't have.
In my
if you don't have-
experience, bankers are always ready to talk to people who are in business or thinking about starting a business, because as much as I was encouraging you to do that so that you can begin to build a relationship, banks similarly are in the business of trying to help businesses. And so, they're very willing to spend the time. Again, my prejudice is to the smaller community banks, but you can really help yourself, and the banks are going to be very open to it.
And if you don't have the business checking account, the separate business checking account that we talked about, now would be a good opportunity to reach out to Debbie or to Robert.
We have a question in chat that says using a cash flow statement seems like a great idea. Should I reach out to the bank to assist? Well,
No.
I can tell you. Yeah. That's where SCORE comes in. Yes. Yes, reach out for a SCORE mentor, and that's where SCORE comes in. We will help you get that cash flow statement.
And the reason I say that is because one of the things that the bankers are going to want to understand that you understand your business and that you have a handle on your business. And you may well, you'll have a perfectly viable narrative to explain. But SCORE can help, and that's a much better place to go than walking into the bank and saying, could you help me figure out, what my cash flow is? That's not the best way to start a banking relationship, in my humble opinion.
But once you have that statement and you want to open a checking account, then you might want to go in and say.
You absolutely do. But I will also tell you that it looks hard to start, all these Excel spreadsheets and charts and everything else. They're really not that complicated. If you can balance a personal checking account, you can very easily figure out how to do the business cash flow. You sit down and you think about, what are the expenses of my business going to be? Don't even bother with a spreadsheet. Do it, in hand on a legal pad with columns.
Especially if you've already been in business, because you've got some historical information to work with. So if you've been in business for a year or two or more, you know, most of the hard work has already been done. You've got some, as I said, good historical information.
And things aren't going to change from history unless there's something that happens externally or internally. So
Right.
that's always where you would start, is what were my, what were my expenses last year? And I know as well as anybody that you're in a small business and everybody says you have to do this, and that. And you're in the position where you're hooked up to a fire hose and the thing's on full blast and you don't have time to do all of that. And the receipts go in a shoebox in the closet and you'll get to those when you get to them. It's just a matter of figuring out what you can do and what you can't do. And you can do a very simple cash flow, looking at your bank statement for the next 6 months, the next 12 months in an hour. And SCORE is perfectly happy to help you to what I will call give that the smell test. Does that make sense? The best way to use SCORE is not to walk in and say, here's the box of documents. How do I put this together? It's to sit down first before you walk in and think about, okay, what is my business bringing in cash and what is my business putting out in cash? And then we can help you to put that into a format that will work for you and work for any external parties that you're trying to deal with.
Okay. Well,
I also wanted to add to something that Jim said earlier when he was talking about the 5 Cs. Thank you, Jim. I always meant to take a screenshot of that page.
No royalties charged, don't worry.
But one thing is, so actually as a banker, the first thing I look at is cash flow. And I look to see if the cash is going to be sufficient to support the amount of debt that they're requesting. On the collateral side, it's tricky. A lot of services businesses don't really have very much in the way of collateral. So, and a lot of times, even the collateral that can be pledged, we wouldn't really consider a source of repayment. So that's why this cash flow seminar is especially important. Getting ready to speak to a bank.
okay, well, we've definitely gone over time, so I want to wrap this up because I know a lot of people are having to leave. I just want to thank East Cambridge Savings Bank for sponsoring this webinar, and I definitely want to thank Gloria and Jim for giving so much fantastic information. And I know that from the thank yous in the chat that everyone else appreciated it as well. So everyone have a great, I guess we've only got one more day to our week, but have a great week.
Thank you, you too. Thanks.
Thank you.
Take care, everybody.
Bye-bye.